Alrighty, so for this video here, pretty much going over the entire range of April 16th. This is micro NQ, so all of these markups would pretty much be concurrent to the structure that develop itself after midnight into 9:30's window when you're typically looking for the volatility to come into play and where you're expecting for the move to continue into certain particular lows since we're bearish on this day. And in a sense, you can gather your entries into understanding how structure is supposed to play out if you are going to be bearish intraday. As you can see, just looking at some of the structure here, that the delivery did change, and we ended up hitting that projection level that I was pretty much looking at in case we did decide to go long. Initially, my bias was long, but I'll tell you exactly where I went wrong with that. It was just, again, not submitting to time and being patient and waiting for the market to take what it needed from the sell side of the curve first, making its way downwards. And this is a 15-minute chart. This is an hour chart here on the right hand side. So if you notice, coming down here into this 9 o'clock candle here, which is pretty much what we're seeing here being shown as a lower high, this lower swing point. In this lower swing point right here is that candle opening range for the 9:30 stick. We're just looking at it off of the 15-minute chart, which is pretty much this down close candle here. So that's what that orb looks like on the hour. I'm gonna take it away just to highlight certain things. So I'm gonna put it on this current interval and below so that disappears. And now you can pay a lot more attention to that leg of structure. So, we know that price is pretty much failing to trade higher in a sense. So theoretically, if price is failing to trade higher, then you would just see it move lower. You're anticipating that when price breaks and trades lower, and you're looking for entry in a particular level going lower, which you need to see, market structure break and continue, moving lower, things of that sort. And you target these levels of support that the market establishes within its downpour. This is how you get your projections. Now, when it comes to anticipating market flips, that is a whole different story. But I get into the buy side of the delivery as well. Primarily, let's just focus on the sell side, because really, this is pretty much all you would need to capitalize on a good move and just be done for the day. You don't need to catch the buy as well. So just going over the initial leg of structure, the market established a high after midnight. And if you've been paying attention to how the algorithm seeks liquidity, creates the upper end and lower quarters of the range after midnight, then you know the importance of why the highest candle high and the lowest candle low is pretty much notated and marked off after midnight. Typically, this is where the high and the low for the trading day is formed. So realistically, if price is going to continue to expand, either going up or down, then you would want to see price trade into this high and of course trade into this low. Now, as it continues to expand, you'll notice exactly that the higher time frames candle is expanding down as well, and it will trade into these very same particular levels that are resting on the 5-minute, the 15-minute, the 30-minute. You're looking at the fractals within that candle's range exposure based off the higher time frame, but you're really seeing what's truly inside of that candle's range when you look at it from a lower time frame, if that makes sense. So you're seeing what caused the rally up within the wick, where you see the swing point being formed. You feel me? Second candle here, candle to the left, lower high, candle to the right, lower high. That's how you know this is a bearish swing point, because this candle is higher than this candle here on the left and lower than the candle on the right. That is how you establish swing points and swing lows within the marketplace. It would just be flipped. Now, again, the high of the day was pretty much made at midnight. Oh, after midnight, sorry. And on the 15-minute chart, that high comes in at 3:30 in the morning. That high is pretty much this 3 o'clock candlestick. And if you notate that off, you see how that high right there pretty much plays into that same area. This is just how it looks on the hour. Now, as price expands and trades down here, going to the 4 o'clock range, notice how we leave an imbalance here in between this 3:30 a.m. low and this 4 o'clock high. Price leaves an imbalance. We were previously sitting within a range, consolidating. And notice where you see the consolidation take place after we swept the highs, resting back here in Asia. How many points did you see? You know, the market pretty much trade up. So this is like the little things that you could pretty much notate or annotate about price. Is how far up does the stop hunting happen? So if I take a measuring tool and I drag it from this high in Asia to where the stop hunt began to where it stopped, within 6 hours, price finally got above this high. Well, if I want to be direct about it, it took about 4 hours for price to spike above this high, and the market sat and chopped above this high for about 2 hours. So it took about 4 hours and 30 minutes for it to finally get above this high, based upon the structure here moving lower, retracing the continuation. Took 4 hours and 30 minutes to get above this high, and it sat and consolidated above this high for about an hour and 45 minutes to be exact. Now, the manipulation is about 21.25. So the market traded 21.25, 21-point stop hunt. In that consolidation, we create an area of displacement in these last two down close candles. On a bigger time frame, you know, it looks like bearishness. On a lower time frame, it looks like chop. And we're studying that window within that consolidation and identifying that 15-minute fair value gap within it. So they're giving a sense of it being attached to that range. And when we trade back into this area, this can lead to opportunity to sell again. So if you're just following the simplicity behind market structure, you would know that when market trades back into a support, that support later becomes something known as, you know, our break in market structure, because the structure is no longer trending up. You know, we're no longer forming that sequence that you see with price forming higher highs and higher low swing points. We are now getting that flippage away from those highs and now making lower highs and lower low points. So visually, you know, this is how you would internalize that structure, but on every time frame, the structure will look a little bit different depending on the fractal that you're looking at price within. So the higher the time frame you go, the more dragged out and exhausted the wicks look. When you go and you look into those particular time frames to study that structure, you can really see exactly how the move is pretty much setting itself up, and you're studying that move indirectly to how it looks to the higher time frame, but on the lower. So the market structure breaks underneath this candle's low at 26455.25. So breaking market structure, shifting market structure, we're no longer getting a sequence of bullishness. Once the market has decided to trade underneath this low here, that comes in at this coordinate, we're bearish. So we trade underneath this low. We enclose this range. Very last down close candle, up move that comes after it. This entire range here, this void, this one-sided delivery, we fill that void here in this down close candle that comes in at 36.75, and in that filling of that void and returning back into that candle's range, notice how we have an imbalance within that range. And this is all being done within the 15-minute, just giving you the framework. But we leave an imbalance here. And price later comes and fills that imbalance and encloses the entirety of this liquidity void. And we trade through that void at 4 in the morning through the entire range, and then eventually at 4:30 sweeping that low. At 26,416.50. So if you were the type of person that trades London session, and you know that your kill zone to look at London session is in between that window of noon up to 5 in the morning, that is your window of opportunity, right? Well, did this trade setup form itself in that window of opportunity for you to take your trade? And it did. So in this green shaded area, this is pretty much a pocketed window of price from noon all the way up until 5 o'clock in the morning. Did a trade setup develop here for you to take within London session? It did. So the first initial part of the move, price goes above the high in Asia for about 21 points, including that tick. So 21 points, or 21.25. We create the higher end of the day at 3:30 in the morning, consolidating in London. We finally break that low within that consolidation that was established at 3 o'clock in the morning. We trade through it at 4 o'clock in the morning. We fill this void here and close it while also trading into imbalance, returning back into this candle's range because this is where the orb is. But really primarily you're looking at that low, that swing low, because due to the fact of how liquidity is engineered, the market is magnetized to trade back into these levels. So that 26,416.50 level gets traded through at 4:30 within that candle's fractal, and it pulls away. Now that creates another swing point for us to identify on the correction to move back up, but you're anticipating that if we're bearish, we're going to end up falling back down into this level here to hunt stops, to draw itself back to that liquidity that it's magnetized to currently, because the delivery is bearish. So you look for bearish related things with the market structure. Now, after that window and going into, New York session, we get another exposure of that move going down with the New York session. So what do we do going into New York session? Pre-market. So right here at 6 o'clock in the morning, we trade into that 15-minute fair value gap that we established in between that 3:45 window, but really in between 3:30 and 4 o'clock. We created an imbalance here in this second candle. Looking over to the right hand side of that, this first presented fair value gap gets traded back into at 6 o'clock in the morning, and we create the high of that 6 o'clock candles range, which is what's drawn here on the hour chart, and that move going lower. So if you know that based upon the hour, the 4 hour, the candle is bearish, this is the opening of that bearish candlestick, then that means that price is expanding downwards from this point in the entirety of that range. If it remains bearish, that means that the 15-minute, the 5-minute as well will give you bearish signals to get in line with that entire candle structured range. So it's like thinking about this being the candle on the higher time frame. This entire range here is pretty much that candle, and you see as I'm highlighting this shaded area in price and the expansion moving all the way down, that is literally the same entire high all the way down to the lower wick of this bearish candle that I'm notating off of the 15-minute chart. This is how you keep yourself in line with the structure. So if the leg is going to go down, then you're looking for the same concept to be applied here on your entry-based time frames, and looking at how the candle expands itself on the higher, but how it sets itself up for entry and continuation of structure on the lower. So once we broke this level of support here, and then price made a swing low here, you see how the market came all the way back up and retraced, and then created a lower high here within that presented fair value gap, and then rallied lower. Now when a level of support gets retested, usually that concept behind seeing it become a resistance, you will look for that to hold true. In this sense, it came up just a little bit further above this level of support, which should be an area of resistance. Technically, if you're not factoring in wicks, this level of resistance did hold to be true. And the reason why I say this level of resistance did hold to be true is because wicks do not necessarily represent the true direction of a range, if that makes sense. It really, I don't know if I'm saying that properly for you, but more of the story, what I'm trying to get you to understand is that wicks, the way that I think of them, is they tell you a story, right? And the type of story that wicks pretty much tell you is like, hey, I've been here before, but pay attention to where my actual body is. Where did that candle legitimately close? That is where the true volume is. The volume is within the node itself. It has nothing to do with the wick. The wick just shows you the highest point we've been and the lowest point we've been, but what you primarily really paying attention to is the closure of price within the bodies of the candle's node. You're always paying attention to the node, but you do have to factor in the wicks. So price did still close underneath this level of support, but due to how the 6 o'clock candle opened, it expanded upwards first. So that's the manipulation, the move upwards at 6 p.m., which is the move into this 15-minute fair value gap. So the hourly at one point of time expanded heading up, trade into this 15-minute fair value gap, created manipulation in that move up, enticing buyers. And then as soon as we got in this area, the whole entire candle flipped. Now, that candle, that 6 p.m. candle is pretty much here within the 4 hour. So if I was to pretty much just like real quickly, just like remove all of that clutter and then notate off this 6 o'clock high. Honestly, it's like the simplest thing that you can do. This high here comes in at 26,466 point, well, 26,466 flat. That's literally the same candle high here on the 4 hour. So this is a candle that has a higher time frame confluence. The 6 in the morning. That's that 4 hour high, 1 hour high, 30-minute high, 15-minute high. It has a very good candle for our confluence into understanding that this candle on the 4 hour is going down, this candle on the hour is going down, this candle on the 30-minute is going down, this candle on the 15-minute is showing us a bearish leg of structure initially here. So just some food for thought of how you pretty much want to look at fractals. And I'll put this chart back on the hour. So going back into that, and I'm just keeping it current to where I'm talking about, the 15-minute high here, price falls from there. And then we trade lower. About 6:15, we trade underneath this candle's low at 5:45, which was pretty much that opening range here for the orb on the hour. So if you go to the hourly, maybe I should probably take the chart linking off. But the hourly orb, it's probably this. So let me remove this really quick. Because I have to draw it again in order for the chart link. So see right here, this last up close candle and then the expansion against it, that is the orb on the hour. So title 1 hour orb. Now price trades through that orb, which activates it. This is where you start to study the reaction after we trade back into the level. But we trade underneath that candle's low, that level of support. We rally through it at 6:15. By 6:30, we dump aggressively to the downside, and voila, that last swing point that we rallied away from, the market ends up trading back into it. So this was our low that we pretty much had resting within London. That low gets attacked at 6:30, and the market bottoms out here at 6:45. We trade against that as well, and we create a higher move going up. If you were looking at the live call, you would notice that I pretty much took this low all the way up until this high, and I drew this zone here. The reason why I drew this zone here is because look what price is doing. It's consolidating. So when price was sitting here and consolidating, that means that we are sitting within a holding pattern. The market has not yet determined where it wants to truly go yet. So you need to wait for the accumulation phase to pretty much finish. And then you need to be able to pinpoint exactly, where is all the money? When are we going to get that volume that we're pretty much lacking to send us into a true direction? Even if the direction is short term, short lived, whatever word that you want to use for it. Intraday, just looking at price, it was bearish. So that means you will look for bearish related things to line up with price. You're expecting pretty much that within this consolidation here, this holding pattern, this initial move or this leg, that at some point in time, we're going to get back underneath this low if we're going to remain bearish. But we need to wait for the market to finish accumulating because it has not decided exactly where it wants to send the money to. So one of the best things that you can do to get in sync with either bearish or bullishness, depending on how the market wanted to play out here, is you wait until, when do you expect the most volume to intertwine on the chart, it would be 9:30 in the morning, because that's the open of the stock exchange. So this candle here on the 15-minute chart is our 9:30 opening candlestick. So New York Stock Exchange opens on this candle. Notice how we make a move up, and look how it looks on the hour. So it's like when you're studying inside of these wicks, you can't really see how the move is truly panning out unless you scale down, scale in. This is why it's important to be able to assess the market from the lower time frame and understand where it's going on the higher. Because without this type of understanding of the framework, it makes it very hard for you to get these sniper entries into these candles and then take the trade riding all the way down into these particular levels with confidence that it should go down there. Which is why understanding the framework of the lower time frame structure opposed to how it looks on the higher time frame, just a wick, and you don't see any of those candles that we're seeing here on the 15-minute. This is how you get it to work. So 9:30 we open here. Same thing, we create a manipulative leg or an expansion in a sense going up. Price makes a lower high, and then we trade down very aggressively. So boom, imbalance, and this is an imbalance that's on the 15-minute. We trade into that imbalance. Price creates a lower high here, and then at 9:30 the market sends. Now if you don't enter in already, the only thing that I can honestly say that you could do to get into this leg of structure is you wait for the breakage underneath a candle's low, which is pretty much what I waited for. So this very last up close candle, and then this very next down close candle here. When I see price do this, think of it as a sense as a change in state of delivery. And what I mean by that is, at one point in time, this was like a bullish handle, like it was retracing going up. But what I like to do sometimes is I like to think about price as a line chart. I like utilizing line charts, and I believe ICT teaches this concept as well. Is you can really, and I'm just gonna narrow it down, but you can really use line charts to pretty much understand where the true closure and opening of a candle resides. Though you don't necessarily need it, because like you can see it on the chart, but those bodies are relatively respected off of the line chart swing points. So if I take it back, yes, it's this a down close candle here, but really the lowest close within that range is pretty much that up close candle. So when the market breaks underneath its previous volume node and you're bearish on the trend, this is pretty much how I would be looking to take shorts, because I'm expecting from here after 9:30, in order for us to get underneath this low here and target this level that comes in at 26,364.25, which is where your target would be to either set a TP, possibly break even on the trade, scale out, whatever it might be. But on the higher time frame that this has opportunity, there's a possibility that it might even go lower, which is why you have to learn how to hold the trades and micromanage them based upon the structure. So this breakup structure right here, but also the retest into this support leads to an entry after 9:30, and you got that entry at 9:35. We come back into this level of support. Price rallies up into it at 9:35. you sell short. Stop loss 50 points, that's the most I do, but you get a 48 point stop at the 930 high. I will make this red. Well, I will make this green to represent profit, and I will make the gray, which is representing the stop loss, red, so you know that if the market trades up into that high, you're out of the trade. If it's in the green, you're making money. So you're risking 48 points. Of course, you're looking for the low right here to get targeted for about 40 points, but that is not where your true objective is. You know, this is possibly an area where you can like scale out of your position that you're already within. You know, maybe you use like 6 micros like I did, and you scale out of the position and set a stop loss, you know, closer. Instead of 48 points, maybe you drag it down like 20 because you're up 40. So you're just trailing your stop. So you're risking 40 to catch 40. And as it drops 40 points, you move your stop loss up 20 points. That reduces the risk. Your trade is being managed and you're still in profit. A lot of times you do have to let the market structure breathe. So now you have a 20 point stop. The market has expanded for about 40 points. As it trades underneath this low here, and we create the lower low within the range, that level of support gets traded into. So if we establish a level of support here, and then the market rejects off of it, that creates our retracement. So in this same candle going down, we retraced going up as well within this 940 stick, and we retest that same level of support again here at 940. By 945, which would be the next opening range for the 15-minute candlestick, since I'm already on the 5-minute, I would have to go to the 15-minute here. And the particular candle that I'm looking at is 945. So if I just wanted to get to that area, I could just go to that candle and go to 945. Oh, sorry, it's showing it for April 17th. I have to do it for the 16th. So 16th, 945. And you can see it highlights that specific candle for me. So look how it looks here, where you can see the breaks a lot earlier on the 5-minute versus where the break happens here on the 15-minute. This is why you have to narrow in, because when you narrow in, you get better entries into where you already see price going. It's not here to confuse you. It's here to give you better entries into the direction that you're already picking and choosing. You just have to know exactly where is the entry. And that's the easiest and or can be the hardest part, because of the signals that you might see on a lower time frame. You have to be able to fine tune these things and narrow out the unimportant things of price so you can stay in sync with it. So that low here that is formed at this blue shaded horizontal line is again going to be the support for the 945 candlestick, because it's the next 15-minute opening. So it shows us here at 940 the retracement. It's really the ending exposure of the 930 stick, and then within continuation of the 945. So it kind of intertwines a little bit. But that support being made here at within that 930 candlestick, within that move up, we came and retested this level of support 2 times, created a lower high, and then the market dumped off again at 950. Within that 950 to 1010 macro, that's usually what you'll see. It's usually where you will see a market protraction happen. A second, and let's make this like I have a brain fart about colors. Let's make that pink. Make these lines black. Well, matter of fact, I'll just remove the lines. But in that 1010 to 950 macro, usually where you'll see a market protraction But honestly, it's also has to do with the opening of the next 10 hour, well, my bad, the next 4 hour slash 1 hour candle opening. That 10 o'clock candle is an important candle. It's the next opening of the 4 hour, the next opening of the hour, the next opening of the 30 minute, the next opening of the 15 minute, so on and so forth. And you'll start to understand this as you study fractals, taking the opening PO3s of really any candle's range. It could be the daily, the 4 hour, the 1 hour, and you study those fractals on the 30-minute and lower time frame. At 950, we move lower, trade underneath that level of support. We break it. And this becomes a target, also a possible re-entry. Why? Because we have displacement, very strong displacement going further down. But really, you're looking for the trade in the correction before we move down. You honestly never need or want to try to get in once the move has already exposed itself, because by that point, your risk becomes unmanageable. The trade has drawn itself out too far, and now you have no area to properly set your stop loss. So if it does retrace and takes you out because it wants to correct first before moving back down, now you lose a shit ton of money and you miss out on a big move. And because of that, you don't get back in because now you're scared, because you lost a lot of money off of a unmanageable trade of, well, unmanageable, not an unmanageable trade because you could sit in it, but unmanageable risk, cooks your account. So 950, we move even lower underneath this old level of support, and this expanded for an additional 103 points, all within this 5-minute candle straight to the downside. And then we bottom out and create the low of the candle's range here at 955. And the market never came back to this low. So if we understand daily fractals and pretty much how that works, then you would know from an algorithmic standpoint that 1800 GMT here is the opening range of the entirety of the daily candlestick. We've traded underneath that candle's low a long time ago. All the way back here from 6:05 p.m. We finally traded into that level at 9:50 in the morning. So if you were to just take a measuring tool or a date and price range and you drag that all the way out to when we finally traded into this level here at 9:50, it took us 15 hours, roughly 16, to get back to this area of where we've previously established the trend going up for the daily PO3, and trade through that level with aggression and bottomed out and made the low at 950. Now you know where your data low is, aka low of the day. But for me, I just call it data lows or data low. And removing the market protraction window, taking all the clutter off. Now you can start to understand how the trade model is forming itself and how you can anticipate a new direction to unfold. Because once we bottomed out here and created a data low, notice how the trend started to change. The delivery is no longer bearish and it's now going up, and it expanded all the way up until this red level here. And notice how we hit that red level to the pip, literally 26562.75. This candle high here at 12:15, pretty much the ending of the profit taking hours, or where you typically see the high of the day being formed. We formed that high on the candles in day at 12:15, at least according to the 5-minute. But this candle high as well comes in at 26562.75. So it literally traded into this old level um, of buy side. This level here comes directly from the daily. This is literally an PD array from the daily time frame. So if I was to go and move over to the daily chart and look for that price level, it's pretty much this price level right here. This candle high that was formed on the 28th of January, which was 2 months ago. We finally traded back into this high from 2 months ago on the 26th of April. So it took a while for us to get back into this area. And even then, same thing. If I was to take a date and price range and drag it out to the right until we finally hit this level, you see it took roughly 56 bars, 78 days for us to get back to this high and trade into it. Crazy, right? Now, dropping this back down to what time frame was this looking at? Can we leave it on the hour? Yeah, I can leave it on the hour. Put this on this time frame and below. Just trying to clear up some of the structure here, so all that clutter, with some of the annotations, so all that clutter isn't in the way from what I want you guys to see. So now that I've focused on the sell side of the curve, let's focus on the buy side after we establish the data low. So keep in mind that when you're utilizing the IPDA concept, then you know that after midnight, when the market opens, this is where ICT teaches you that, this is when the algorithm kicks in, comes into play, and this is where you start to notice the high or the low of the day being formed after midnight, or the high or the lower end of the range being formed after midnight. So midnight opening price is definitely a way that you can keep yourself in line with the higher time frame structure. And moral of the story, the way you use it is you pretty much look for trades to form above midnight opening price for you to take shorts, and below midnight opening price for you to take longs. It just depends on what side of the delivery is being handled. So initially, after midnight, the market came up. This would represent bullishness in a sense, but this bullishness is just a manipulative move that happens after midnight. In a sense, you have a range here that you're dealing within. In this range here, this very small range here that you're dealing within after midnight that's being formed, you're pretty much looking for the market to trade within the lower ends or lower quarters of that range and expand going downwards. Once price is below midnight opening price and you have your conditions and framework being met, you sell below midnight opening price, because that means that the candle is bearish. So if you're below midnight opening price, you sell short. If it remains bearish underneath midnight opening price, you target the old levels. A very simple concept. Same thing for when after midnight opening price and the market decides to sell off initially and then create a level of support. Never trades back into that support, but you're expecting that the buy side of the curve or long is happening. That means that you're below midnight opening price. Not only are you getting the best discount for a long, but now you know how to aggressively target the highs on the left hand side of the chart, because if you're below midnight opening price, you're expecting to be bullish. That means price needs to come back above midnight opening price, and then same thing as it did on the downside, it needs to do on the upside, which is target these old highs and things of that sort above midnight opening price. And you can use these things for, target projections. If you like to set TPs and all those things, this is literally how you form all of your TPs, on your chart. And of course, that very last one all the way back here from 78 days ago, that high that was established on the 28th of January. Correct me if I'm wrong. So coming back, looking at that low here, looking at this chart on the hour, and then all the framework that we have on the 15-minute, looking at this initial leg, initial move lower, So we had this handle, and this is literally where I got in this move here. If you've seen the entry model from when I posted inside the chat, for me, this break underneath this old level of support, the trade up, you sell short. You're expecting that the next, 10 minutes that comes out, it's going to continue the leg of structure going lower. You sell, price breaks, you hold. And that's how you pretty much get your trade idea. So it ends up turning to 1-2 when you wait for the break. Though the first presented entry is all the way back up here. But, you let price trade into the orb, play itself out, retest 1-2. Next 10 minutes that comes out, price expands and creates the entire range of the 15-minute range going lower, which in theory creates the the higher time frames 30-minute, and that creates the hour, which is why we expand going lower. After 9:55, the market no longer went lower anymore. It decided to go higher. How do we know? Because look at the swing point. We have this candle here. It's always in between that second, and it's always kind of identified between that second candle, and you just look to the left and to the right. I know that this is a swing low point because this second candle here, this up close candle, forms the low. And then if you look to the left hand side of it, this low is pretty much lower than these two candle lows on the left and right. So this is low, this is a higher low, and this is a higher low. So low, higher low, higher low. This is our swing. Price creates a level of support, fails the trade underneath this previous candle low, and it keeps doing that, creating a higher low, and then retraces again, creates another higher low. Same thing, second candle to the left, candle to the right, higher than the second candle's low. So this is a swing point. And it just keeps doing that over and over again, stacking, going up, creating levels of support. This is how you know that the structure or the retracement, in a sense, is bullish and upholding. And if you're expecting that from here, the market won't come back down to this reference point, that data low, and we hold from up here, you look to take possible, longs. So if you were studying, the buy side of delivery, you would think of it as this sense. There's a fair value gap here, and price trades into that fair value gap and fills it entirely at 10:05. Now, when it comes to anticipating the shift in the market structure, notice how at 10 o'clock, we formed that range, trade into that orb, that low that was left here at the low of the day at 9:54. If you look all the way to the right of it and you find the higher end of that range, now you've identified your dealing range. So I could take a zone here and drag it from this low to this high and look at this pocketed window of price. And if you wanted to just go deeper into it, you could draw a midline, and now you have the 50% of that range. It's pretty much known as like consequent encroachment. Really, when you have 50% of a range, the lower quarters of that range is discount, the upper quarters of it is premium. So in theory, if the market is going to retrace, you'll see it happen in the premium. That's usually when you could tie it up with concepts such as sweeps, because stop hunts happen above old highs. So that's what you're supposed to use to keep you in line and where retracement could possibly form. So see how we sweep this candle's high back here at 9:42 and create the higher end of that candle's range at 10:12. The market drops, and this is happening when the 3-minute chart trades into this order block that was created at 10 o'clock. Down close candle, explosive move up, activates it. We trade into it at 1021 and price rallies. And then the high that gets target is this high here at 1012 because there is resting orders above this high, liquidity. That is what the algorithm is attracted to. That is what it's going to seek. That is what it's going to attack. This is how you stay in line with it to make your money. So it continues stacking and respecting that bullish order flow all the way up until we get back above midnight open. Takes buy side from these levels here. Rallying through them until we get all the way up to the high of the day, which is why you'll see me notate this as being, a data high. And that data high was created and established in a London session. And we rated that high and attacked it at 11:15. This is how it looks opposed to the hour. To trading all the way up to that high from 78 days ago at that price point of 26,562.75. So hit it straight to the pip and then it flipped and we retrace going off into the end of the day and all the way up until 1700 GMT, which 1657 on the 3-minute. That is the close in the entirety of the range. So if you look at the range from the beginning of the end, from where we opened to where we closed, wasn't much move on the sticks from a day perspective, but it was enough movement within a range for you to capitalize on the entirety of anything going either down or up. So it's a bullish day. This is a bullish model, but you still had opportunities to participate in counter trend trading, if that's what you want to consider it. Really, you're just mastering how to trade within one range, where to exit, and then how to get into a new one and when to exit. So it's a forever changing story. Sometimes it will be one directional, sometimes it will be, two sides to the book. And what I took is one side, and this initial leg here is another side. And who knows, you probably get the last and final delivery in the afternoon, but not focused on that. After we expand and we head up, the order flow just pretty much just remains bullish. That's when you start seeing a lot of shit working, fair value gaps, things of that sort being respected. The market creating these initial legs of ranges that price sits within before it finally expands, creates a low, expands, creates these highs, retraces, creates a higher low in a sense, that creates these supports and then expands again, and then we finally get to that level, trading above the buy stops with the liquidity resting above this high. And this is how you get your full exit on the trade. So the sell side of the curve from 9:30 all the way until the low where we bottomed out here from 9:30 to 9:54. It took 24 minutes for the market to move 177 points. And really, I just rounded off to 178 points. So it took 24 bars. It took 8 bars, 24 minutes. This is based off of the 3-minute chart. For us to get all the way down here and create the low of the day. Now, you as a trader, you have to be able to know when enough is enough within a range. Typically, how many points are you even aiming for? You get what I'm saying? So if you don't even understand that, you wouldn't even know what you need to be getting out of these two initial legs that formed the move for you to get in, you need to know when to get out. So the way I like to think about it is, if the market is creating a range and expanding, and that range expands for over 177 points, all you really need out of that range when the opportunity has presented itself is like 50 points, 60 points, 70 points. 70 points out of a 177 point trading range, you're still leaving 100 points on the table, yes, but those 70 points is life changing money. You feel me? 70 points, you are already trading and catching 50. And, let's say that you were tying this to NQ, because right now this is on micro. So the lot sizing is pretty much going to vary. But, let's say you're trading NQ and you're not on micro NQ, and you just catching 50 points on NQ is literally $1,000 out of a 177 point range. But initially, let's say you do catch your little 70 points or whatever from out of the range, from wherever you got in, and you're just using one contract. Those 70 points literally just made you $1,400. And you're done just off of that initial leg going down lower. You don't need anything else. At that point, you're just trying to gamble. But it does give you, other trading approaches, other models. You could have took the buy as well. I just took the initial move lower and I was done. I didn't need to catch all of this. Market's been bullish. We know that it's been bullish from the higher time frame, but it gave us opportunity to take a short and get out before the market wanted to get back in sync and go long again. And I think that was a pretty good interpretation of the handle. Really, from this markup after midnight until what it does going into the end of day and closing for the entirety of the range. You could study, the afternoon session. Quickly just like annotate things that come out of here. Like these relative equal lows here that the market created and it stabbed through. You have this these swing lows that are created, and see how we create those fair value gaps and establish those swing lows in the fair value gaps. A little order block here, but it didn't tap into it. It did sweep a candle's high though and fell short. Same thing here. Fair value gap, fills it, trades into that very last up close candle, creates that lower high. Same shit here. Now we have the gap, gets filled, creates that lower high. Price expands going lower. Then these three lows here get traded into because the market is magnetized to liquidity. I'm trying to draw a little magnet. So that pretty much explains the trading approach for Thursday. The reason why I took shorts, what I was looking for, shorts. Really, I did have a long bias, but I just didn't do it at the right time. It was definitely something I would have had to wait over 30 minutes for. In that sense of waiting 30 minutes for that long, why not take the short within that 30 minutes until you get the long? You get what I'm saying? So it's like 30 minutes of you waiting for the buy to play out versus you participating in the short that played out for those 30 minutes and you get out. So hopefully everything made sense. And see you guys on the next one.